You bought your home years ago for $300,000, maybe even less. Now in 2026, the market has pushed the value to $600,000, $700,000 or more. You're excited. I've built serious equity, $300,000, $400,000 in gains. Time to sell, cash out, downsize, move closer to family, or upgrade. You picture the closing check hitting your account, feeling like you've won the long game. Then the surprise arrives. After paying agent commissions, 5 to 6%, closing costs, repairs from inspection, and staging, you get the net proceeds. But the biggest shock comes from the IRS capital gains tax. You owe $20,000, $50,000, even $80,000 plus on the profit you thought was mostly yours. Suddenly that big win shrinks dramatically. You walk away with far less than you expected, and if you're planning to buy another home right away, the reduced cash can push you straight into a tighter mortgage, higher payments, and deeper house, poor territory. This isn't rare. In 2026, the primary residence capital gains exclusion remains unchanged at $250,000 for single filers and $500,000 for married filing jointly. Section 121 still locked since 1997, despite inflation adjustments in other tax areas. Long-term capital gains rates stay at 0%, 15%, or 20%, depending on your taxable income brackets. Inflation-adjusted thresholds, roughly 0% up to $49,450, single 15% up to $545,520 above that, plus the 3.8% net investment income tax. If your magi exceeds $200,000 single/$250,000 joint, many longtime homeowners, especially those who held 15 to 20 plus years, see gains well over $500,000, meaning even after exclusion, they owe serious tax. The brutal math hits hard. A $700,000 sale with $350,000 basis and $30,000 selling costs equals $320,000 gain. Married couple excludes $500,000 zero tax. But if gain is $650,000, you owe 15 to 20% on the excess $150,000, $22,500 to $30,000 plus NIIT if income high. That's money you can't reinvest or use for retirement. Continuing our series on hidden cost house, poor HELOC danger. And post-closing surprises, today we expose the capital gains tax surprise. Exactly how much you'll really owe when you sell your home in 2026, how the exclusion works, the rates, the hidden adjustments, and proven ways to minimize or eliminate the bill, so you keep more of your hard-earned equity. If you're thinking about selling soon, or you have significant equity built up, watch this entire video. It could save you tens of thousands in unexpected tax. Let's dive in. In 2026, the capital gains tax surprise when selling your primary home remains one of the biggest hidden costs because the rules haven't kept up with reality. The Section 121 exclusion, the amount of profit you can exclude from tax, has stayed frozen at $250,000 for single filers and $500,000 for married filing jointly since 1997. Despite inflation pushing home prices higher every year, Congress has not adjusted these thresholds for inflation even after the 2025 One Big Beautiful Bill Act kept most TCJA provisions intact. Meanwhile, median home prices are stable around $430,000 to $450,000, but many longtime owners who bought in the 2000s or 2010s now have gains well above $500,000. Average realized gains on primary residences are $100,000 to $200,000 nationally. NAR data, but in high appreciation areas like California, Texas, suburbs, or the Southeast, it's common to see $300,000 to $700,000 plus gains after 15 to 20 years of ownership and improvements. This mismatch creates the surprise homeowners assume I lived here long enough, the profit is tax-free. But if your gain exceeds the exclusion even by $100,000, you suddenly owe long-term capital gains tax at 15% or 20%, plus the 3.8% net investment income tax. If your modified adjusted gross income exceeds $200,000, single/$250,000 joint, that can turn a nice windfall into a $20,000 to $80,000 IRS bill overnight. The math gets fang when you factor in selling expenses, 5 to 6% commissions, closing costs, staging repairs, from buyer negotiations, often $30,000 to $50,000 on a $600,000 to $800,000 sale. These reduce your net proceeds even before tax hits. Many sellers only realize this after the contract is signed and the title company prepares the 1099-S form. By then, it's too late to adjust strategy. Now let's get into the exact calculation so you can avoid this surprise yourself. To avoid the capital gains tax surprise, you must calculate your actual taxable gain correctly. Most people get this wrong and end up overpaying or shocked at the bill. Here's the precise formula used by the IRS in 2026. Taxable gain equals sale price minus selling expenses minus adjusted basis sale price. What the buyer pays you, for example, $700,000, selling expenses, agent commissions, 5 to 6%, $35,000 to $42,000, title fees, transfer taxes, staging repairs to close the deal, anything directly tied to the sale, adjusted basis. This is the key most people miss. It's not just your original purchase price. Adjusted basis equals original purchase price plus capital. Improvements plus buying closing costs minus any depreciation if you ever rented it out. Example, one common case, you bought for $300,000, including $10,000 closing costs at purchase. Over 15 years, you added $80,000 in improvements. Kitchen remodel, $40,000, new roof, $20,000, bathroom, $20,000. Adjusted basis equals $300,000 plus $80,000 plus $10,000 equals $390,000. You sell for $700,000 with $40,000 selling expenses. Gain equals $700,000 minus $40,000 minus $390,000 equals $270,000. Married filing jointly, exclude $500,000 implies taxable gain equals 0. No tax. Example 2 surprise case. Same purchase but improvements only $30,000. Adjusted basis $340,000. Sell for $800,000 with $45,000 expenses. Gain equals $800,000 minus $45,000 minus $340,000 equals $415,000. Exclude $500,000, arrow still $0 taxable. But if gain was $650,000, higher sale or lower basis excess, $150,000 is taxable at 15%, assuming mid-bracket income equals $22,500, plus 3.8% NIIT. If MAGI high equals another $5,700. Total tax $28,000, money you didn't expect to lose. The brutal math, forgetting to add improvements or selling expenses, inflates your gain by $50,000 to $100,000, easily costing $7,500 to $20,000, plus an extra tax at 15%. Track every receipt, kitchen, roof additions, even landscaping that adds value. This calculation is the foundation. Next, let's dive into the exclusion rules. Who actually qualifies for the $250,000/$500,000 break in 2026? and what happens if you don't meet the tests. Now that you understand the basic calculation, let's talk about the single most important piece that determines whether you owe capital gains tax at all: the Section 121 exclusion rules in 2026. To qualify for the full exclusion of $250,000 single or $500,000 married filing jointly, you must meet two main tests. Ownership test. You must have owned the home for at least 2 years out of the 5 years immediately before the sale date. Use test. You must have lived in the home as your primary residence for at least 2 years out of the same 5-year period. The 2 years do not have to be consecutive. You can add up periods of living there. For married couples filing jointly, only one spouse needs to meet the ownership test, but both must meet the use test to get the full $500,000 exclusion. There are also partial exclusions for special situations: job relocation, 50-plus miles, health reasons or unforeseen circumstances, divorce, natural disaster, etc. In these cases, the IRS prorates the exclusion based on how long you lived there. Example: a widow sells after only 1 year. Because of health issues, she may qualify for a partial exclusion. For example, 12 to 24 months equals 50% of $500,000 equals $250,000 excluded. Important restrictions: you cannot have claimed the exclusion on another home sale within the last 2 years. Vacation homes, second homes, or investment properties do not qualify for the full exclusion. Only your primary residence does. The risk here is huge. Many people think, I lived here 10 years. I'm fine, but if they rented it out for a few years, moved out early, or didn't track residency properly, they miss the exclusion and owe tax on the full gain. That can turn a $300,000 profit into a $45,000 to $60,000 plus tax bill. Next, let's look at the actual tax rates you'll face if any gain remains after the exclusion. Once you've applied the exclusion, any remaining taxable gain is subject to long-term capital gains rates in 2026, assuming you own the home for more than 1 year, which most primary homeowners have. The rates are based on your total taxable income, including the gain itself, and follow these inflation-adjusted brackets. For 2026, 0%. If your taxable income is $49,450 or less single, or $98,900 or less married filing jointly. 15% for most middle to upper income earners, single up to $545,500, joint up to $613,700. 20% if taxable income exceeds those upper thresholds. Additionally, if your modified adjusted gross income MAGI is above $200,000 single or $250,000 joint, you pay an extra 3.8% net investment income tax and IIT on the gain. Example: married couple taxable income before gain is $120,000. They sell and have $150,000 taxable gain after exclusion. Total taxable income equals $120,000 plus $150,000 equals $270,000. Arrow falls in the 15% bracket. Tax owed equals 15% times $150,000 equals $22,500. If MAGI is high enough for NIIT, add 3.8% times $150,000 equals $5,700. Arrow total tax, $28,200. The brutal math. A large gain can push you into a higher bracket or trigger NIIT, increasing your effective rate from 0% to 18.8% or even 23.8%. Many sellers are shocked because they didn't realize the gain itself counts toward their income for the year of sale. Short-term sales hold less than 1 year are worse taxed as ordinary income, up to 37% common for flippers or quick moves. Risk underestimating the gain or overestimating exclusions can push you into a higher bracket, unexpectedly costing thousands more. Always model your full year income before selling. Now let's look at how you can legally reduce the taxable gain even further. The good news is you can significantly reduce or even eliminate your taxable gain by properly adjusting your basis upward. The higher your adjusted basis, the lower your gain and the less tax you pay, what adds to your basis. Capital improvements that add value or extend the life of the home kitchen remodel. New roof, bathroom addition, HVAC replacement, deck, landscaping if permanent energy-efficient windows, finished basement, etc. Cosmetic fixes like painting usually don't count, but major renovations do. Buying closing costs, title fees, transfer taxes, legal fees, recording fees, and survey costs from when you purchased. Other qualified items, certain carrying costs if you built the home or made substantial additions. What subtracts depreciation taken if you ever rented out the property even part-time? Example, you bought for $300,000, including $8,000 in buying closing costs. Over 15 years, you spent $60,000 on qualifying improvements. Kitchen $35,000 roof, $15,000 new HVAC, $10,000 car, adjusted basis equals $300,000, plus $8,000 plus $60,000 equals $368,000. Sell for $700,000 with $35,000 selling expenses. Gain equals $700,000 minus $35,000 minus $368,000 equals $297,000. Married filing jointly, exclude $500,000. Arrow taxable gain equals 0. Tax saved potentially $44,550,000, 15% bracket, compared to if you ignored the improvements. Advice: keep every receipt, invoice, and canceled check for improvements go back as far as possible. The IRS accepts documentation even years later if audited. Many homeowners leave $20,000 to $100,000 on the table by not tracking basis properly, paying thousands in unnecessary tax. This is one of the most powerful ways to minimize your bill. In the next part, we'll cover the most common pitfalls that cause people to owe tax they didn't expect. Even with the exclusion and basis adjustments, many sellers still get hit with unexpected capital gains, tax bills because of common pitfalls. Here are the biggest risks in 2026 that turn a tax-free sale into a costly surprise. Number 1, missing the exclusion rules entirely. If you don't meet both the ownership and use tests, own plus live as primary residence for at least 2 out of the last 5 years, you get no exclusion or only partial. Many people rent out their home for a few years, move out early for work, or buy a new place before selling the old one, then realize they don't qualify. Result: full gain taxed at 15 to 20% plus NIIT. Number 2, gain exceeds the exclusion even after long ownership. Holding 15 to 20 plus years with strong appreciation common in 2026 markets often pushes gains over $500,000 for married couples. After excluding $500,000, the excess is fully taxable at 15 to 20% plus 3.8% NIIT if income high. Surprise: $100,000 excess equals $15,000 to $20,000 tax bill you didn't budget for. Number 3, short-term sale hold less than 1 year. Flipping houses or quick moves trigger short-term rates taxed as ordinary income, 22 to 37% brackets. Even if you meet exclusion tests, short-term gains don't get the preferential long-term rate. Number 4, failing to track and prove adjusted basis. If audited, IRS flags large gains, you must substantiate improvements and closing costs with receipts. No documentation, IRS disallows the additions, arrow gain increases, arrow higher tax, plus penalties. Combined real-world example. Married couple sells after 18 years, purchase $350,000 improvements, $80,000 selling cost, $40,000 arrow-adjusted basis, $470,000. Sale $1.1 million arrow gain, $630,000. Exclude $500,000 arrow taxable, $130,000. At 15% bracket plus NIIT, 3.8% equals $24,440 tax. They thought long hold equals tax-free but missed tracking $30,000 in undocumented improvements, pushing taxable gain higher and owing an extra $4,500. The brutal math. These pitfalls don't just add tax, they multiply stress force, dipping into savings or delay your next home purchase. Many sellers only discover them after signing the contract. Now let's flip this around, proven ways to legally minimize or eliminate your capital gains tax bill in 2026. The good news is you can often reduce or completely eliminate capital gains tax with smart planning. Here are the most effective strategies for 2026. Maximize your adjusted basis, document everything. Add every qualifying improvement, kitchen remodel, roof additions, HVAC energy upgrades, and buying closing costs to your basis. Keep receipts, invoices, and photos. Even $50,000 in documented improvements reduces gain by $50,000, saving $7,500 to $10,000 at 15% rate. Time the sale carefully to meet the full exclusion tests. Ensure you've owned and lived in the home 2 out of 5 years before listing. If close, delay closing until tests are met. For partial exclusion cases, job, move, health, gather proof early. Use 1031 exchange, but only for investment properties. If your home was ever rented or is not primary, consider converting to investment and doing a like-kind exchange to defer tax not available for pure primary residences. Offset gains with capital losses. Sell underperforming stocks, crypto, or other assets in the same year to generate losses that offset home gains dollar for dollar. Example, family has $550,000 gain after exclusion to $50,000 excess. They sell stocks at a $50,000 loss, arrow taxable gain $0. Tax saved potentially $7,500 to $11,900. Real example. Married couple with $550,000 gain. They document $80,000 improvements, basis up, time sale to meet tests, full $500,000 exclusion. Sell $50,000 in losing stocks. Arrow excess gain. Eliminated arrow, owe $0 tax. Advice, consult a tax professional or CP. 6 to 12 months before listing. They can model scenarios, check state taxes. Some states have additional capital gains tax and spot overlook deductions. Don't rely on online calculators alone, they often miss basis details or NIIT. These steps can turn a $20,000 to $80,000 surprise bill into zero or minimal tax, keeping more equity in your pocket for the next chapter. Now let's wrap this up with the key takeaways and what you should do next. To sum it up, capital gains tax when selling your primary home in 2026 can be a massive surprise if your gain exceeds the $250,000/$500,000 exclusion, hitting you with 0 to 20% long-term rates, plus 3.8% NIIT on the excess. While most long-time owners with modest gains walk away tax-free, those with big appreciation common. After 15 to 20 years often owe $15,000 to $80,000 plus unexpectedly. The exclusion hasn't been inflation adjusted since 1997, so rising home prices push more people over the limit every year. The brutal math is clear: profit from your home isn't all yours to keep. The IRS takes a cut if you don't qualify for full exclusion or track basis properly. Selling expenses 5 to 6% commissions, repair, staging. Already reduce your net proceeds by $30,000 to $50,000 on a typical sale. Then tax takes another chunk. This reduced cash can make buying your next home harder, forcing a bigger mortgage and deeper house poor pressure. This ties directly to our series Hidden Costs Don't End at Purchase. They continue through ownership. HELOC risks repairs and hit hardest at sale. House poor isn't just monthly payments, it's also the lower net proceeds from tax and fees that limit your next move. Final advice: calculate your exact gain and tax liability before listing, use adjusted basis model scenarios, and consult a tax pro early. Track every improvement receipt, time the sale to maximize exclusion, offset with losses if possible. These steps can save tens of thousands and protect your financial freedom. The math is fufang. Your home's profit is not entirely yours. IRS takes its share if you're not prepared. Don't let surprise tax steal your equity. Now I want to hear from you. Are you thinking about selling your home soon? Drop in the comments your approximate purchase price, current estimated sale price, how long you've owned/lived there, and your city/location. I'll reply with a quick personalized tax estimate based on 2026 rules, gain calculation, exclusion, eligibility, potential tax owed, and tips to minimize it. If this video helped you avoid a costly surprise or just opened your eyes, hit like, subscribe, and turn on the bell for more 2026 real estate truths. No fluff, just the hard math and facts. Thanks for watching. Sell smart, keep more of what's yours. See you next time.